Hi, welcome back. It's Neil here. Yes, you're going to get another example from me. The best way to learn accounting is through examples. Of course, there are the whys. We're spending a lot of time in the lecture talking about the whys and the whole purpose of going through these calculations. So let's have a look at a good example here. And what we were focusing on is chapter 14 of Horngren, Cost of Management Accounting. We're really looking at customer profitability analysis. And remember, let me bring in our pointer, our famous pointer. We've got our laser pointer. As I said previously, we looked at value engineering, which is part of the target steps of target costing approaches to driving cost benefits through reduction of costs, either through functional analysis, that's the pricing positioning of a product in the market, design analysis, which is the actual design of the product and designing in more modularity or the different components into the product so you can save money, and process value analysis, which is more about operational improvement inside the activities of the organization. These are under value engineering. Step 1 and step 5 of target costing is all about that. That's all about reducing costs. We really haven't spent much time on can we get information to improve decisions which can drive profitability of the organization. And yes, we can. Yes, we can. I'm so glad there is a way. And there is a way. And it's a way of creating a customer profitability profile, which is about applying activity-based costing concepts, which you already know about from in chapter 5 of Horngren. In even basic management accounting, cost management accounting classes, they've taught all about activity-based costing. You use that so you can get more accurate cost allocations to products, so you can make better pricing decisions, better scheduling decisions, better competitive market decision making. So we can use the same concepts to apply to customers so we can make better customer profitability decisions. If we know the different customer profitability profiles that comes from allocating different revenues and costs to the different customers, then we're in a better position to manage those customers, boot out the unprofitable ones, and manage with more intensity, creating richer experience, bundles of products for the more profitable customers you have in your portfolio. So that's what customer profitability analysis is. We're about applying concepts of activity-based costing to your range of customers so we can use the customer profitability profile to improve decisions, such as booting out customers, spending more time on the profitable customers in the organization. So let's have a look at this example, shall we? So we're interested in customer revenue analysis and customer cost analysis. As I said earlier, customer revenue analysis considers all activities that affect the net amount received from the customers. Customer revenue analysis traces the prices and the discounts, including sales and cash discounts to customers, and identifies financing costs associated with customer revenues. You see, not all customers have the same bargaining power. Suppliers that supply to Apple have to wait for up to 3 months to get paid, whereas if you go to those same suppliers, they'll want cash immediately. It depends on the bargaining power of the customer, that not all customers pay the same price when it comes to purchasing and bargaining for negotiation purposes. So because of different bargaining power, you may offer more discounts to your bigger customers, the ones that have more power. So we want to try and quantify this range of pricing that you have given across your customer portfolio. We want to quantify the range of financing options you have given across your customer portfolio. Once we quantify it, we're in a better position to ask questions. Are we doing the right thing by keeping our less profitable customers? Who are our more profitable customers? You see, we can start to make better decisions about whether we can offer them more products in the future. So let's have a look at a good example. And we're coming back to Pro Values. Remember, Pro Value is a division of Astel Computer. We saw this example in chapter 5 with activity-based costing. We started to apply activity-based costing to its computers And we saw this also in chapter 12 of Horngren, chapter 13 of Horngren, where we actually looked at a target costing example about how pro value can actually make the computer for a lower price. And we're talking about the typical manufacturing cost of $680 at the time. But now we're actually looking at the customers. And from the get-go, we can see that there are different customers of Pro Value. These are 4 of Pro Value's 10 wholesale customers. We're not showing all of them, just enough so you get the idea about the different resources these customers are consuming. They also have different selling price after a price discount is offered to these different retail customers. So for example, A and G may have more bargaining power, so Pro Value has to offer them a much higher discount than customer B or customer J. Wow! So therefore the final invoice price is that B is given the most money. B and J are providing the highest prices to Pro Value per unit, whereas A and G are providing next to the lowest prices per unit to Pro Value. You can see that right from the get-go at the revenue level that not all of these customers are the same, and we can find out their revenues accordingly. And so that's the first starting point in understanding the revenue analysis in customer profitability analysis. Let's get to the next exhibit, shall we? So we want to remind ourselves what we're talking about. Pro Value, taken from an earlier chapter of target costing analysis, was done on Pro Value, had a cost of goods sold of $680. Pro Value was selling on average each computer for $1,000. Of course, as we saw from the previous exhibit, some customers on average were only paying $950, others were paying $1,100 or $1,050. So you see, the average is $1,000, but not every customer or retail establishment was paying on average $1,000. That's the total average. Some customers were paying more, some were paying less. What about the operating costs? We have all of these costs we may need to consider. So let's just keep in mind that we've got all this information and we're minded about the revenues that Pro Value is trying to get for its computers. So here's the talking point when we come to customer revenue analysis. Not all customers pay the same price, number one. Number two, not all customers have the same payment terms. Some may pay later, some may pay earlier. 3, not all customers will pay at the same time. Some customers may choose to pay earlier. Some customers may actually delay in their payment, incurring you more finance charges than what you have budgeted for. Okay, what about some of the different activities that may cause costs to be different across the different customers? So we're talking about the cost side of the customer cost analysis. Order processing costs, billing, collection, payment processing costs, accounts receivable and carrying costs, customer service costs, return or allowance processing costs, restocking costs, and selling and marketing costs. All of these costs have the potential to vary from customer to customer. So what we're trying to do is, maybe we don't want to consider all of these costs individually. We may want to group them according to different categories. That is, customer unit level costs. That is, a cost will use of the resource varies with the size of the unit order. Or customer batch level costs. That is, an order size, so therefore ordering costs varies with the number of orders, not the size of the orders. What about customer sustaining costs? We're talking about visits to the customer, to look after them, to answer their concerns, to keep them on good relationship terms, and so forth. These are all customer sustaining, keeping the customer relationship strong in the long run. What about distribution channel costs? Well, we may distinguish between commercial channel and a retail channel, and so those costs may be different in terms of those categories. And finally, we may have sales sustaining costs that's associated with the marketing that's undertaken by the firm as a whole, just to push sales from quarter to quarter to quarter. Okay, let's get into the good stuff of the calculations. Before we go any further and allocate costs to different customers, we first want to develop our driver information. So the best area is, let's have a look here. The best area, and we want to get a pen here so we can ideally circle this part here. We want to come up with a rate per driver. This is very important here. This is what we're going to use as the basis for allocating different costs to your different customers based on how much they use each of the resources. So for example, a sales order is driven by the number of sales orders, and there's the total cost of the activity taken from ProValue's financial statements. There were a total of 6,000 sales orders during the period, so on average it cost $1,125 to process each sales order. Now, let's just step back from this for a moment. Remember, if you look at the profit and loss statement, we have the cost of goods manufactured, the cost of goods sold, but then we have three little piggies underneath gross profit, and that is sales expenses, finance expenses, okay, administration expenses. They never factored into the product costs. They never factored into the inventory, but they are driven a lot by the different resources that customers consume in order for you to sell to them. And here they are here. Sales, the cost of selling will go into selling costs. The cost of visiting customers, number of customer visits, the total cost of that activity taken from that area of product profit and loss. And there were 750 customer visits, so therefore for each visit, on average, is $5,600 a visit to each retail store per customer visit. We can do that with wholesale channel marketing, business sales channel marketing, ProValue division administration, total marketing administration costs. So again, we've got several other groups of costs here: 800,000, 1350, $1.9 million. And the first two of these are distribution channel costs. They are the costs associated with a particular distribution channel. Whereas the last one is a division sustaining cost. That is the division that actually makes and sells computers, ProValue computers. This is the highest order of costs that we want to contain. We can look at distribution costs in the same way: product handling, regular shipments, rush shipments. And so we can actually see that product handling, the driver is cubic feet. So we have our total product handling costs, a total number of cubic feet that was used during a period. And so our cost driver, the rate per unit of cost driver, is $15 per cubic foot. What about regular shipments? We have total costs of shipping, $3,750,000, so that's $3.75 million. 3,000 regular shipments, so we've got 1,250 per regular shipment. And the same for rush shipments. There was $750,000 incurred for just 150 rush shipments. Wow, these are expedited orders. This is where a customer rings up and says, I want the stock tomorrow. A huge flood of customers have come in. I'm out of stock. I want it tomorrow, not in 30 days. I want it now, or I'm going to another vendor to supply me. Okay, so let's rush it, but that's going to cost you money. You may have to resequence your whole ordering, your whole logistics chain, and that's going to cost you money. That's where that 750,000 comes from. We divided by 150 of those incurrences, so we get $5,000 per rush shipment. And so you can see this rate per unit of cost driver is basically the cost of these different resources for the particular cost driver, for the particular unit. At the end, we've got customer service, number of units shipped, and we had 150,000 units shipped. That's $24 per unit shipped. So you can see that we've got these rate per units of cost driver, the most important part of setting up your customer profitability analysis spreadsheet. So let's have a look at the next stage, where what we want to know next is what were the amount of resources that each of the different customers consumed of these cost drivers. Did your range of customers consume any of these resources differently? That's the big question. Let's have a look. Customer A, retail establishment A, had 1,200 sales orders, 1,000 sales orders for B, 600 for G, 300 for J. Interestingly, G didn't require as many visits as A. What about product handling? Well, A moved much more cubic feet than J. What about regular shipments? A had double the amount of G. What about rush shipments? A had the most, J didn't have many at all. What about units shipped? A had 30,000, B had 25,000. So you can have a look at some of these resources that were consumed by the customers and ask that question just even before we attach dollar amounts to these resources consumed to get our customer cost analysis. We can start to think which customer is costing us more. What about expedited shipments? A seems to be costing us a lot, but also A is ordering a lot. G is ordering about half, much less, 5,000 versus 30,000 of A, but over 20 rush shipments, nearly as much as A. So in some ways, G seems to be much less profitable than A as a customer. So we are looking at this from the big picture here and looking at the different resources that the customers are consuming of your activities, that is sales, administration, and financing activities. So let's have a look at when we combine these resources used with the rates per the various cost drivers. Welcome back. So we have the different customers of Pro Value, and notice the revenues that they have brought in: 33 million, 27.5 million for customer B, 5.5 million for G, 4.4 million for J. For A, you had to offer a high price discount, that is $3 million. You didn't have to offer any discount for J. So the net revenues are adjusted for this discount that you offered. What about the cost of goods sold? That is the basic calculation of $680 times the number of units shipped to each of the customer. So that's nothing special there. That depends on the number of orders multiplied by the order cost. That is the unit cost, $680 US. And there we have our margin. Okay, now here is the application of the customer cost analysis to these 4 different customers. We have sales orders, 1.35 million to A, 1.125 million to B, 675,000 to G, 337,500 to J. That's the number of orders multiplied by the order rate per unit ordered. What about customer visits? Interesting, J didn't have as much customer visits as A. What about distribution costs? We have product handling of 900,000 allocated to A, but only 150,000 or 120,000 allocated to G and customer J. What about regular shipments? Interestingly, we had A having twice as many shipments as G, but rush shipments, A only had a little bit more than G. As I mentioned earlier, G had many more percentages of rush shipments compared to A. Hence, there's a greater proportion of the shipment costs allocated to G versus B versus J versus A compared to the total shipments of G. And then we have customer service allocation at the bottom. Obviously, customer B requires a lot of service, 600,000, nearly as much as customer A. I wonder if the shipments match the percentage of customer service. We can find that out in a minute. So we have our total customer level costs of 4.6 million, 3.5 million, 1.7 million, and 858,000 to customers A, B, G, and J respectively. Customer operating level income 4.9 million, 5.6 million, minus 350,000 and 821,000 for those 4 customers. Not all of those customers are equally profitable, and the calculations are down here to check against what we have got in this table. So what are we trying to do here? We're trying to combine the revenue analysis with the cost analysis to come up with customer profitability profiles. And this enables us to rank the customers from most profitable to least profitable. And when we do this ranking, then we're able to make decisions like, where should we focus our strategic customer acquisition efforts? Where should we focus our customer exit efforts? Where should we focus our customer fee increasing efforts? So maybe we want to focus that on our less profitable customers. So we force them to either leave or pay additional fees to support the extra costs associated with looking after those customers. So these are different decisions that you may want to make. Let's have a look at how we can prepare, how we can display this quantitative information for management to make these decisions. So we can have it in terms of a customer profitability profile here, from the highest profitability customer here to the lowest down here. Or we can graph it, and it's these customers in this area here where we want to focus on our strategic customer acquisition. This is where we may want to focus our bundling or different products or services together, and or sell new products and services to these more profitable customers. We may want to avoid these customers because even though they may say yes to new products, they may require more maintenance, they may ask more questions, they may create more returns, they may create more headaches, they may create poor reviews of your products, they may be just complaining no matter what you do for them. All right, so you want to avoid these customers, and you want to focus on these customers in your sales and marketing strategy. And so now we've got information that management can use to make better decisions. In the end, here is the spreadsheet. There, we use that information to create some useful graphs that you can show management when they haven't got time to look at all the details. But when they see this, then you can get their attention, and you as an accountant, your job is to get management's attention with the numbers. You may baffle them with all these numbers, but the graphs may help them piece together why you are focusing your strategy on one segment only. Here's an example of Sanyo Limited, a company that I have been involved with over 10 years ago in terms of being able to visit and get information about their customer profitability. And these are all real electronics companies, from the most profitable customer down to the least profitable customer. And it's the ones down here that we want to avoid, and we want to have more customers like these. So even for a basic factory in China, there are profitable customers here, there are very unprofitable customers down here. So there are many other factors that we need to consider in evaluating customer profitability. For example, the likelihood of customer retention. It's very important that you think about the cost of retaining customers, and we need to also think about the potential for sales growth. Sometimes the unprofitable customers may turn out to be profitable in the long run. How can you distinguish the good unprofitable customers from the bad unprofitable customers? That may take some more data mining and understanding the different characteristics that shape a long-term profitable, sustainable customer of yours. What about the importance of having the firm as a customer for future sales references? You don't want to lose a customer and have that customer to complain about you and cause other customers to leave you as a result. What about long-run customer profitability? Yes, again, we want to understand the profitability of customers over the long run and not just in one period. So we may want to track a trend. We may want to, when we go back to here and look at the customer profitability profiles, we may want to look at this over a 3-period term. So from 6 months to 6 months to 6 months, for the last 18 months, here are the customers that are in the top profitability profiles. Here are unprofitable ones. So we don't want to have a customer that's only profitable just for one term and make a poor decision, like invest more money in that customer and it turns out to be unprofitable in the second term. So that takes us to the end of this second example, or the example that's in chapter 14 of Horngren 15th edition, where we have used activity-based costing concepts to apply to different customers. In this case, it was the different wholesale customers of Pro Value, and we allocated these different costs using cost drivers, and we found that not all customers had the same profitability. In fact, some created losses for Pro Value, and in turn, when we graph that information, then we're able to inform management to help them make better decisions. For example, strategic customer acquisition decisions and customer retention decisions, or maybe customer exit decisions. So there you have it. Catch you in the lecture. Keep going. The customer profitability analysis, very, very valuable both for service and manufacturing firms. Catch you on the flip side. Thank you for watching. Bye.